Good morning, I'm David Kaskel and this is Saxo Bank Market Call. Today is the 17th of December. On Friday, the big story was about inflation, which was creeping higher across the board. Eurozone CPI month-on-month and year-on-year both higher than expected. The same goes for the US, with month-on-month at 0.8% versus 0.6% expected, and headline year-on-year at 4.3% versus 4.1% expected. CPI core at 0.3% month-on-month versus 0.2% expected and 2.3% year-on-year as expected. To sum up, for the past 3 years, the core year-on-year CPI change has been above 2% in the US. That's a serious problem for the Fed, which has been cutting rates rather aggressively lately to stem what seem to be problems from the subprime mortgage market. And the whole question is now if that was a good thing to do, or they're just risking that inflationary pressures will build additionally from here. Also, then we had the Aussie dwelling starts for third quarter out at 1.3% versus minus 2.5% prior. So that's generally a positive for the Australian dollar. Massive dollar strength on Friday due to the very high CPI readings, and carry trades are also edging lower. Stocks quite weak in US session and on worries that the Fed will have to hike rates again. ASX 200 is down 3.5% this morning, and on fixed income, long-dated contracts were hurt by higher inflation and worries about additional hikes, but they're still keeping up the prices from the past 2 or 3 weeks. Commodities weak on US dollar strength, and a cause for concern that precious metals are not able to move higher on inflation figures, which they generally should, but that is on dollar strength. Crude oil is edging lower, and that is also due to dollar strength apparently. So what's going on? Well, inflation is a big story. US core inflation year-on-year has not been below 2% for a single month in the past 3 years. And PPI year-on-year was out on Thursday last week at 7.2% year-on-year, which is the highest since 1981, and that's a serious problem because back then we had serious problems with inflation. G20 GDP-weighted CPI is now running at almost 4% year-on-year, so that is also a problem. Inflation is really across the board, and therefore we're also seeing in STIR futures that they are not pricing in as much as much cuts as they did 2 weeks ago, just on a 1-year horizon. It seems that these very bearish sentiment in rates expectations has completely changed towards a more hawkish stance among the STIR futures traders. Today's economic figures, we have the most important is the U.S. current account balance, which is expected to come out at $183 billion deficit, which would be the highest, or the best, so to speak, figure in 2 years, and signal a long-term turnaround in the current account deficit. And then we have the NHB housing market index expected at 19. That was also the reading last month, and that is still the lowest reading ever in this measure's history. And across the board, we're seeing stories about investment banks cutting bonuses, and that may help to reinstate a bearish mood in Wall Street. Today's economic figures, we have the Norwegian trade balance at 9 o'clock GMT. We have the U.S. current account balance at 13:30 GMT. We have the Empire Manufacturing at 13:30 GMT, and then at 14 o'clock GMT, net long-term and total net tick flow data out of the U.S. At 1800, we have the NHB housing market index, as I said, expected at 19. In the next couple of days, we have the UK CPI and RPI, that's tomorrow, very important, and also Swiss retail sales. We have Canadian CPI, and we have also the US housing starts and building permits, and then on Wednesday, we have the German PPI and IFO figures. We have the Riksbank rates and the Bank of England minutes. One FX trade for today in Euro Yen. We have support at 162.40 and resistance at 164.30. We have placed an order to buy at 163.52 bid with a stop offer at 163.32 and targeting 164.25. To the downside, we have a signal to sell at 163.06 offered and targeting 162.20. Stop bid at 163.25. Generally, we are positive on the US dollar and Swiss franc today, but most other currencies we don't like though. So continued dollar strength today, that is what we're counting on. On equities, we are generally bearish on equities. We believe that we'll see some spillover effect from both the US and Asian sessions. We don't like financials due to the fact that we're seeing some very high inflation figures, and the expected support from lower rates that should have been priced into financials in the past couple of months may fail to materialize due to these very high inflation figures, and therefore their borrowing costs will probably be somewhat higher than expected during the next 1 or 2 years. And therefore we don't like financials, and generally we believe this sector will be performing the worst. And also what will be performing good or best is probably agriculturally related sectors, like we have the tractor company, actually, tractor supply company in the US. A very interesting company that might be related to this agricultural service. We also have wheat prices out at $10 now. That's the highest ever, and we actually believe that we're just finalizing the yearly outlook for 2008, and that's one of our outrageous claims that wheat prices will actually double during 2008. On the last note, on futures, we have a trading strategy out for gold, to sell gold around $798 or $800 per ounce area, and a stop at $802 per ounce and a target at $790. That's due to the fact that gold is not able to go higher on these inflationary figures, and then on continued dollar strength, of course. That is it for today, and thank you for joining me here on Saxo Bank Market Call.